Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Thank you for being part of our program here today. We talk about financial matters, talk about investing, financial planning,
saving
retirement,
for retirement,
all kinds of exciting
college
things.
funding.
Yeah, both myself and my co-host, we're both practicing financial advisors. We spend the weekdays helping people plan their futures, and we are here on the weekends broadcasting to be your financial advisors on the air. So whether you're listening to us, whether you've got financial advisors you work with now or you do things on your own, we want this to be a place for additional information and hopefully some thought-provoking
But if they're
ideas.
listening to a podcast, I think that would be narrowcasting, not broadcasting.
I stand corrected. Thank you,
Just
Pat.
think
Okay.
about that for a minute.
There we go. So anyway, I think we've got a good program lined up today because we put it together. But the second half of the program, we're going to be joined by Andy Stout, our Chief Investment Officer. We're going to go a little deeper into
The markets and what's going on and inflation and
it's the strangest of times.
Well, you look at what happened, the fires in the West, and we're in the Sacramento. We broadcast out of the Sacramento or narrowcast out of the Sacramento area. And so far there's been 660 homes they think that have at least burned down. You look at in New Orleans, you look at the flooding in New York City that is happening in New Jersey, and you wonder, is this not will this not be a little bit inflationary? Is this enough to start driving inflation significantly? Because all of a sudden there will be demands on the system, and the system is having a hard enough time actually getting it through, right? Products and goods to the consumer. Think about all the automobiles that have lost in parts of the U.S. because
just this week,
Hurricane Ida.
I think on Thursday, General Motors said they're going to idle all of their plants because they can't get the
chips,
the parts they need.
Yeah. So there's a couple.
I had my car in for service at the dealership a week or so ago. The showroom, there was literally one car inside the showroom. And I was talking to the service manager guy, and I said, this must be a big challenge for you guys. You don't have any cars to sell. He says, you have no idea. And then he said, there's those big container ships full of cars, like out in the Long Beach Harbor.
Yeah, I read there were 44 of them, the most ever.
He said he says the cars are all ready to go. They're just waiting for their last little electronics to be plugged in. That's all they're waiting for. A little stick that thing in, and
this is inflationary. We'll talk to Andy Stout about that in the second half of the show.
It is the most bizarrest of times. I must.
Yes.
I got to tell you, the financial markets, it's like it doesn't matter what the bad news is, it charges ahead. And keep this in mind, next time the markets go south, which they will at some point in time, you're going to have all the pundits on there, all the reasons why it's going south. Don't believe any of it. Because it's
nor should you believe why it's going up either.
We can't necessarily predict those. You can't predict the financial markets
over short periods of time.
Over short periods of time. It is the most bizarre.
It's a strange thing. You just wonder if it's...
There was an article. No, I saw this article. I was frustrated this last week reading the Wall Street Journal, which I'm almost like addicted to the thing. I read every article, not every article, but if I skip a day, I go back and read the previous days. It's all on digital, of course, but it's almost like People magazine for people in business.
Well, since Rupert Murdoch and team bought it.
I think it's gotten a lot better, frankly.
Do you really?
The nice short little stories I can catch up here. If I want more research on something, I can go somewhere else for it. It's perfect. I shouldn't say it's perfect.
I miss the old Wall Street Journal.
But there was a question related to a few financial advisors on how you should invest money if you're going to be buying a house in the short term.
And what were the answers?
Well, the one advisor's like it's got to have to be in cash, except a low rate of return. But other ones, they never really quite stated what it was, but like maybe only half in cash, the other half invested in the market. They never quite described what the market was. And I remember just scratching my head like, this is at a time when stock prices have had a phenomenal run.
Real estate.
I remember in 2000 talking to a guy who had his property tax money invested in some .com tech mutual fund. Remember when the .coms? And he'd tell me that. I looked at him like he was from Mars. I'm like, it was the most bizarre thing. That's where he had the money that he was going to pay for his property taxes. He had invested in this fund because things are going so well. And of course, by the time he needed the money, the things had pulled
turn.
I mean, short term, it's anyone's guess.
How big was his property tax bill that he actually allocated that to an investment?
Whatever it was. I mean, what kind of financial planning is that?
Yes.
I mean, the thing is that if you've got a long time horizon, you could afford to deal with the ups and downs. Matter of fact, you get compensated for dealing with those ups and downs by a higher rate of return. A short time horizon, you better just...
The risk premium, it's called a risk premium for a reason. Your returns above and beyond that of bank guarantees is a risk premium.
It's called in academic circles.
Okay, all right. Okay, all right.
Who else out there? If you look at the capital asset pricing model.
Okay, forgive me. Okay. I'm doing a radio show.
It's called risk premium for a reason. Anyway, if you want to join our show, I'd love to take your call to be part of the program. 833-99-WORTH is the number. 833-99-WORTH. Numerically, it's 833-999-6784. And let's talk to, we're going to start off here with Dennis in Northern California. Dennis, you're with Allworth's Money Matters.
Hi, thanks for taking my call. I'm a big fan of your show. Thank you for all the sage advice you guys give out each week.
Well, thank you for listening. We wouldn't be here if you weren't there.
That's right. There's no question.
It's kind of a symbiotic
all
relationship.
8 of you.
It's symbiotic.
My question is about a long-term care policy that we have. We're being offered some options, and we're not sure which way to go.
What are the options?
Are you a California employee, retiree?
Yes.
Okay.
Retired California employee. My wife and I joined the CalPERS long-term care program when it started in 1995.
And just for people outside of California, the retirement system, CalPERS, Public Employee Retirement System, they decided to help with I think the goal was to help with their members by working with some insurance companies or an insurance company to come up with a group policy of sorts to offer to their members that members could buy into a long-term care policy back in the 90s, mid-90s when interest rates were quite a bit higher. Insurance companies didn't have a lot of experience in long-term care insurance. It was a relatively new product. And so, Dennis, continue on.
So at the time when we joined, there were promises that rates would not rise. But in fact, of course, for the last 26 years we've been paying into it, rates have risen. And there was a class action lawsuit brought about that. And what we're facing right now are choices from the fund itself and choices from the settlement.
Yes.
So from the fund itself, we currently are paying $278 each per month for the plan, which is a total of about $6,600 a year.
And what does the plan cover?
What does it give you?
The plan currently, it's an excellent plan. At the moment, we're each covered for $427 per day maximum in nursing homes, less than that for in-home care or for assisted living care. It includes an inflation factor, and there are no limits either on time or on money paid out.
And is there an elimination or wait period before it begins making its first payment?
There is, and I don't recall.
Probably 90 days.
If it's 1 month or 3 months. I don't remember which it is.
All righty.
Yes. So anyway, CalPERS is, in order to keep our payment the same, by about a couple weeks ago, we would have had to have opted for a decrease in those benefits, putting a cap of something like $900,000 on it, on the payout. And we we passed on that, so that option's off the table. But in November, it's going to jump to $427 a month, which will be for the two of us about $10,200 a year. And then next year it's supposed to jump again, and the total would be about $12,800 a year to maintain that kind of Cadillac version of the benefit.
What about? I mean, so here's how I view long-term care insurance. It's most families can fund a shorter stay, a year, 2 years even. It's the long-term one. It's the early onset of Alzheimer's or something else where it's several years or even more than a decade, right? That's where it can be totally devastating to a family's finances, the longer-term one. And a lot of policies, people buy policies with these short waiting periods, like they call elimination period, or I think that's what they're called.
Yes.
Yeah. So it's like a deductible on auto insurance or deductible on homeowners insurance. But people oftentimes will have these really short ones. Well, if you look at statistically, I mean, last I looked, a male, when he goes into a long-term care facilities, it's a little less than a year. Typical woman's a little less than 2 years. It tends to be your last stop on the way out, right? I mean, most people at that stage, when you're in a nursing home, it's kind of your last chapter there. And so it's those shorter things, the typical things that many people can self-insure for. It's the longer things that they cannot. So one of the reasons that Pat had asked, like, how long is the waiting period on this? One way to try to structure this, if this policy will allow, and I'm not sure, is to structure a longer waiting period,
like a 2-year waiting period,
or a year or 2 years even.
Does it allow for that?
That is not that wasn't in the offer from CalPERS if you want to avoid the increases. But the settlement is giving us other options.
Okay.
One is to just receive the amount we've paid in, and your benefit is canceled. And we've paid in just shy of $80,000 over the years. But that would pay for about 6 months in a nursing home at today's prices. So that's not really an option for us.
Dennis, how old are you?
I'm 69. My wife is 68.
Okay, so still young.
We're both in pretty good health, but we also both have chronic long-term issues that could lead to a substantial nursing home stay someday. So that option is out for us because neither of us could go out and buy new long-term care insurance with our health histories. The next option is that they would take in the settlement, they would take that $80,000 and they would go out and find another plan for which we wouldn't have to pay any additional monthly fees for. But
that's not going to get much on there.
Exactly.
And is that medically? Do you have to underwrite for that as well?
No, there's no underwriting for it. But it'll only pay up to $185 a day for 3 years.
Yeah.
Which
forget it. You don't need that.
Benefit worth about $200,000.
Yeah. Because the other insurance company doesn't want the risk either.
Yeah.
That's why they.
And part of what's happened, and anyone who's owned long-term care insurance, Dennis, has had experiences not quite as bad as what CalPERS has had, because
I'm going to disagree, Scott.
Okay.
And the reason I disagree is because this was mispriced to begin with.
Well, that's what I was going to. It was
okay.
And then they didn't, when they should have repriced it years ago, they didn't. So it went years looking like it was a great deal, and all of a sudden, whammo! It was a shock to many people. But it's two issues that the insurance companies have dealt with. One is they paid out much more in claims than they originally underwritten for. So they just didn't think it would be as highly used as it was. So kind of like with people if an insurance company had a lot of fire insurance in Northern California or a lot of flood insurance in Louisiana, claims are much greater than they were anticipating.
And they didn't have great experience underwriting morbidity risk. So disability policies happens the same thing, and long-term care. Insurance companies had great experience in writing mortality or life insurance policies because they had been doing it for so many years. Yeah. And people have been keeping track of mortality since the beginning of time. But morbidity is something completely different. And so they mispriced the claims environment in which they thought they might live in. The second thing
is the low interest rates.
So you bought this thing when interest rates were in the 8s and 9s.
Well, I mean, the insurance companies, when they get the premiums, they put them in. They invest it for their reserves for when they have to make claims, and they can't take on risks like long-term investors can. Like, oh, we're not going to need these dollars for 10 years, so let's go ahead and invest in the stock market. They have to be very conservative with it. So it's in mostly fixed income, some shorter-term fixed income, treasuries. I mean, their portfolios are earning such paltry returns. And that's where they used to get a big chunk of the revenue they needed to pay out the claims. So it's like this double whammy that's hit the insurance companies, and now it's hitting you.
And so, Dennis, what do you think you should do?
Well, we're thinking of not taking any of the offers of the settlement at all and staying with CalPERS. And although we had an option, a selection for reducing our payments by reducing the benefits that we pass on a couple weeks ago, we'll probably have that same option when they bring about the second increase in 2022. And the option that we passed on, we're kind of regretting it maybe, is it would stay at the same maximum of $427 a day and continue to be inflation adjusted. But there would be a lifetime cap of $935,000. So, and it covers, as I say, in-home care and assisted living care, in addition to nursing home care. So I know my mother-in-law had this policy, and it paid out for a number of years, including at least 2 or 3 years in nursing home care, and it didn't come close to actually covering the full amount. It covered maybe 75% of the amount.
So, I mean, you're essentially you're gonna be stuck with a $4,000 increase next year, and then $6,000 a year increase, right? So over the next 10 years, you're looking at maybe an extra $60,000 paying into this.
Well, that's not an increase; it's just payments. So it's how much?
No, the increase.
Is it an increase?
Yeah, from $6,600 a year to $12,800 a year. So you'll be in 2 years from now, you'll be paying about $6,000, double what you're paying today.
Okay.
So the question here's how I would look at it. You said that you both have some chronic illnesses that's probably going to increases your odds compared to the typical 69 to 68-year-old couple, right?
Yeah, that's our feeling. Although we're in.
Yeah, that's how insurance works. You take it, right? Yeah. You're trying to minimize risks here. And so I would look at it like, do you have enough cash so that if $60,000 were spent over the next decade on additional long-term care insurance premiums, it's not going to impact your lifestyle whatsoever? If that's the case,
that
is
the case.
Then
pay it. Or self-insure. What's your overall net worth?
We have about $3 million in our retirement savings, and our pensions and Social Security all combined is about $259,000 a year.
Okay, and are you spending any of that $3 million?
Sometimes, like when we put solar on the roof.
I would keep this.
Like that.
I would keep it too.
And just from the basic,
it's not going to really matter at the end of the day. You're just going to feel better about it. You're just insuring a portion of your portfolio,
and your family will feel better about it if they've got these dollars coming in. It'll be much easier for them making decisions if you ever have to get to that point.
What you're doing is you're insuring a portion of your retirement.
Gets passed down.
To get passed down. That's what the insurance, because you have enough money that you could self-insure.
The only thing I would look into is if you can lengthen that waiting period.
But
it's highly unlikely that they're going to do customized in a settlement at this point.
Yeah, they haven't. They this last August, what they did was offer 3 options. CalPERS.
And by the way,
you couldn't buy this today.
You couldn't buy this today,
even at this price.
This is not poorly priced relative to the market. You've probably shopped it.
Well, he's not insured. He's probably not insurable today.
Even if he was, it's still not.
But he's not.
But also,
that's the bigger issue.
The program is closed to any new.
Yeah, that's correct. Yeah, I'd keep it.
Yeah, it probably should have never been opened in the first place, quite frankly.
And you can't, the hard thing about insurance is you look back and you think, we've been paying these premiums since 90. Well, you also had the insurance all those years, right? It's like when you have your homeowner's insurance and your house doesn't burn down.
You don't get mad about it.
Not really. Insurance. No one likes paying insurance premiums. Right?
I paid in over.
I hate insurance premiums.
I paid over $100,000 in insurance on my house, and it never burned down. I am really upset. So no, you're fine either way. But I like the idea of keeping it.
I do too. And if it makes you feel better, take a chunk of your cash, your investments, make a separate account. Say this is going to pay the long-term care insurance premium, so you don't feel like it's coming out of your annual expenditures.
Yeah. Well, actually, it comes out of our pension checks, so we don't even see it.
Perfect.
All right.
Perfect.
It's been like a Social Security tax or something.
Okay.
Perfect. Thank you. Appreciate the call.
Yeah. Well, good luck, Dennis. I'm glad you called. I know a lot of people are in similar situations.
And Scott, the way these long-term care policies were sold back in the day was your premium will never go up, which was misleading. Because your individual premium can't be isolated to go up, but the risk pool that in which you exist, it can go up.
It was misleading. They were all sold that way.
They were all sold that way. As was life insurance is sold that way. Universal life. Your cost of insurance will never go up. Well, the insurance companies, they pull risk. And once a risk bucket is full, they move on to the next risk bucket, and that risk bucket lives in and of itself in most situations.
Let's go to the next call here. We're talking with Hank. Hank, you're with Allworth's Money Matters. Hi, Hank.
Oh, hi, Scott and Pat. Thanks for taking
Hank had
my
probably
call.
fallen asleep after the long-term care discussion we were having, but go ahead.
Yeah, I was waiting. A little background. My wife and I have been to all of your seminars pre-COVID, and I got your book, and
Well, I can't. I don't know if this is a compliment or not, because he says he's basically consumed all of our educational resources, but yet still has a question. Is that what, right?
yeah.
So we missed something here.
Obviously, right? That's funny.
Got a master's degree somewhere. Like, wait a minute. Like, how does this work?
So what is your question for us, Hank?
Well, after I read your book, I didn't have umbrella insurance, so I got some, and I got $2 million.
Okay.
And my question is, how much should I have?
Oh, great question. Great.
I mean, kind of a rule of thumb is you have as much umbrella coverage as your net worth, and umbrella insurance it tends to cover things that may be above and beyond your homeowner's insurance or above clearly the limits that would be on.
Right.
And it's an umbrella over both your homeowner's insurance and your auto or boating. And you.
It protects things like you're driving down the road one morning and some young physician's out for a jog and you don't see him and you run him over. And suddenly I'm just saying this, what's the future value of that income that he's no longer going to be there for his family? And suddenly there's a multi-million dollar. Or she, excuse me. Most likely she now, by the way. How much income is that going to be? And then suddenly there's a $8 million judgment against an individual.
And if you have $8 million, they can get it.
If you don't have $8 million, they're not
800,000, then they can get that. So you have $2 million of umbrella coverage. Is that what you said?
Yes.
And what's your overall net worth?
Maybe 5.5.
Oh, do you have grandkids that come over? Right? Do you?
No.
Okay.
No.
So when I think about it, I think about what are the risks?
And I have umbrella insurance.
Oh, I do as well. I won't state that my coverage on the air because I don't want people coming to my house and slipping and falling. my attorney friends, my personal injury attorney friends are inviting themselves over. Can't bring my kids over for a swim. My business card turns into a sponge. So you look at the risk that you're exposed to. So if you're exposed to significant risk, kids coming over, grandkids, teenagers in the house, new drivers, right? Maybe you're not the best driver. I'm not the best driver. You should probably
Doberman
have
pinchers that you raise.
pit bulls. Let's go through the breeds. you should probably have $5 million. And by the way,
It's not-
$5 million isn't twice as much as $2 million.
negligible.
Yeah, it's a few $100 more. So move it to $5 million.
And it could
call
be
a
that
day.
your insurance agent says, your insurance company they personally take on risk up to $4 million. They're going to have to go to reinsurance pool after that. So it might be a big price jump from a certain $1 million mark to the next every insurance company. So you might want to price those things in. Just get some quotes from your agent on what would make the most sense for you. But no question, at $5 million, I would have more than $2 million of coverage. And for the rest of us out here listening, like if you don't have umbrella insurance, it's cheap for
Get
what
it.
the benefits is. Odds are it's not going to be used, but if you need it, you're going to be glad you've got it. We're taking a quick break. When we come back, we're going to be joined by Andy Stout, our Chief Investment Officer. So stick around for more Allworth Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McLean, thanks for staying with us.
We hope you are. Anyway. It's a nice thing about podcasts. You can skip ahead or
Move on.
I've got a buddy who listens to everything like 1.5 times. That drives me crazy.
Someone was telling me that did that the other day too. Like, so what happens? You get home and your wife's talking to you. She's not talking fast enough. You're like, you got to
She's
talk
talking
faster.
fast enough anyway. It was hilarious. My wife and we've been together more than 30 years. And I blew out an eardrum years ago and had to get repaired.
Wakeboarding.
Yes, but it's never quite the same. So I've got this buzz, and that everyone has to, the volume has to be above the level of buzz in my ear or I can't hear. I just got this. And she knows that. And we've had this conversation many times. And so it was a few weeks ago. I'm like, hey, babe, I cannot hear you. I'm sorry, but when you are on the other side of the room and talking to me, I can't hear you. And she says, well, she says, your friends all tell me the same thing they can. But then again, I don't think your friends want to hear me. That's what she says to me. And it's one of those things like, do I respond?
Like how?
That's what she said. Like, do I respond to this one? Oh, no, honey, they love hearing it. How do I answer that?
I'm not biting
No.
I'm not biting
I
on
just
that.
stared. I've learned actually many years of marriage. Oftentimes you just kind of wait until like, do you want me to respond?
You just say, hey, can we talk after I'm finished folding the clothes? Emptying the dishwasher? Something really household centric.
Hold on, babe. I'm cleaning the windows. Yeah, right. All right. We're going to be joined. I don't know how do we get on the tangent. We're going to be joined by Andy Stout here in a couple minutes, but to kind of kick things off, this just came out in the Wall Street Journal a couple days ago. And if you've listened to this program for a while, you know that we've talked about these SPACs.
We talk as negatively about special purpose acquisition companies as we do about indexed annuities.
Yes, worse.
And non-traded limited partnerships.
Yes, I'm trying to think. Like those are good torture vehicles, all of them, right?
Right, and because many things are designed by the Wall Street that isn't necessarily good for the consumers.
That's right.
And when SPACs got popular, 9 months, a year ago, we came out and said, watch what happens. It's going to take a while before these things start blowing up, but they will blow up.
So it's a way to circumvent going on an IPO, and a way for the sponsors to make a ton of money.
And with
promoters,
with little or no disclosure.
Correct. They call them blank check companies.
Yeah, just this is us. This is our thesis. We haven't even bought a company. We don't even really know what company it is, but give us some money, then we're going to go and find a company.
So this was in kind of the crest, the peak of the SPAC boom was in mid-February of this year. And so 6 months after this, the sell-off has wiped out $75 billion out of the value of those companies that have gone public through these SPACs. A group of 137 SPACs that was looked at through the Wall Street Journal's team here from mid-February have lost 25% of their combined value.
When the market is up.
And the analysis doesn't even include the companies that haven't closed mergers yet. So these are the ones that have said, blank check companies, give us your money. We'll tell you later what we're going to buy. Right?
Just trust us.
So this is the time, 25% decline, the same time when those companies, that the exchange-traded funds that track companies all companies that went public, all IPOs are down 12% since that period of time, while the Dow Jones has gained 13%.
Go figure. Does any of this surprise you?
None whatsoever.
None. But the sponsors, the people that put the SPACs together, get rich.
Well, the whole...
You're buying a pig in a poke, as my grandfather would say.
What does that mean? What is a poke?
I think a poke is I think it's a crate that you can't really see through. I believe that's what a poke is. I will look it up on the break.
Thank you. A pig and a poke. Yeah, I need to know. But it's and we see this time and time again with investments, right? People get excited. It's kind of that, hey, here's an opportunity. I can get wealthy quickly. Whether it's the meme stocks, the GameStop, or the
Bitcoins,
AMC,
or
it's some
digital currency.
Short. It's a shortcut to wealth. Instead of having to work hard and save, I'm just going to invest in some things. Or I'm going to take my hard-earned savings, and instead of just relying on whatever the market's going to give me, I'm going to find something that is going to yield excess returns. And in 99 times out of 100, it does not work out well.
It does for some.
For some.
Some people go to Las Vegas and win a lot of money. Most people don't. Most people don't. Some people get rich on the lottery. Most people don't.
Okay. That's a good point. I guess if you both like to gamble and play the lottery, maybe SPACs are fine for you.
Perfect.
Just having a small piece of your portfolio.
Yes.
But it's like, and we had all these celebrities and athletes get behind them. Like, just because you know how to play basketball well, why should I think you're great at running a company or figuring out the best companies? And it's crazy. There's no such thing as a free lunch.
That's interesting. In fact, when they try to buy you a free lunch, don't go.
That's right. That's right. They're selling you something. Anyway, all right.
Actually, that's why if you ever attend one of our workshops, we always have water at the workshops.
Well, to your point, I mean,
we do put out cookies and drinks.
We've never been one to like buy steak dinners and stuff because I don't want anyone to feel any.
I don't want obligation. It's got to be educational based.
Anyway, enough of that. So Andy Stout is joining us. Andy is our Chief Investment Officer. Andy is highly educated, master's in finance of some sort, as well as a certified chartered financial analyst. And Andy oversees Allworth's investment portfolio, which is roughly $13 billion. So, Andy, thanks for taking a little time to be part of us, the show here on Money Matters.
More than happy to be here, Scott and Pat.
And just out of curiosity, because while more people were in the office a couple months ago with the Delta variant and stuff, and people a lot of people are working remotely, where are you at this moment?
I am currently sitting in my study, looking out some trees out the window with the Delta variant just running rampant.
And you're in Cincinnati?
I'm fine right here. I can be just as effective right here. Team is spread out across the country. We talk regularly. So this honestly really hasn't affected me at all.
Which is interesting because I think obviously the market believes that working remotely is not impacting anything. So
at least in the short term.
Well, I mean, it's the craziest thing. How much? I mean, the market just keeps roaring ahead.
You just worry about the lack of collaboration and creativity that is created when groups of people come together. Or, put another way, maybe the chaos and division when groups are put together.
Anyway, so Andy, you're on to tell us what your perspective is on the markets and things right now. But and actually, we have some point of question. Like the Fed's tapering, right? The Federal Reserve. First of all, how much do you think that the Federal Reserve is responsible for the market gains this year? Just out of your curiosity, your opinion.
Well, they're part of it. I mean, whenever the Fed pumps money into the economy, it does slosh around and it can find its way into helping to boost asset prices. But from a bigger picture perspective, even without that, I think we'd still probably be in good shape. I mean, if you look at earnings, just from what companies are making, if we look at the second quarter of this year compared to the second quarter of last year, I know and I completely understand we were pretty much shut down last year, but earnings were 96% higher compared to the same time last year. Wall Street, they were expecting a big increase, but only, and I say only, a little facetiously, 65%. So we completely blew that out. Earnings are really the ultimate driver of stock prices. Earnings in recessions.
And
Andy, when
Andy,
you have recessions and earnings decline.
Andy, what is the earnings relative to 2019?
We're at record levels if you just look at the total level of earnings overall.
And our GDP
So
just surpassed pre-pandemic levels as well, right? Our overall GDP is.
Yeah, so on GDP, yes, we're above pre-pandemic levels. What we're not above on GDP, though, admittedly, is the trend level for where we would have been in the absence of the pandemic.
Clearly.
So when we look at that, we're not quite there yet. When we look at the total earnings path, though, as far as the overall earnings per share, we are above 2019 levels. The end of 2019, the total earnings for the S&P 500, which is your 500 largest stocks in the country, was $164 per share. And right now we're at about 200. So well above that.
And are you worried about inflation at all? At the beginning of the show, we talked a little bit about some of the natural disasters that are taking place across the U.S. may actually lead to a more inflationary environment. What are your thoughts on inflation? And then dig in a little bit on the Fed's easing.
So when I think about inflation, I think far too many people and everything you read out there in the mainstream media, they talk in absolutes. There's no absolutes in this world. I have to think in probabilities. My base case scenario when we think about inflation is that it stays elevated really through the early part of next year before falling off. Now, there are risks to the upside and the downside. A lot of people don't think about the downside risks of inflation, but they're there too. But I would say it is more to the upside because, there's certainly a few things in there that are obviously causing inflation, supply chain dislocation. People, might be pulling back now a little bit with the Delta variant, but getting out and spending more money, the monetary policy, the potentially humongous fiscal policy. That's that $3.5 trillion spending plan that's hitting a little bit of a roadblock right now, but making its way through Congress. It's that $1 trillion infrastructure plan. Employers, they have to pay money right now to get people off the sidelines, right? There's 10 million job openings. That's a record number of job openings here in the country. And when you look at the number of unemployed, we're still about 5-6 million short of where we were before the pandemic began back in February of 2020. That was the high level of employment. So we're still not there yet. So employers will still have to pay up.
So just for clarity, there's 5 to 6 million people, less workers today than pre-pandemic?
That is correct.
Wow. That's staggering number. Yeah,
and if you adjust for the people who just aren't looking for a job, because if you look at the unemployment rate right now, it's about 5.4, 5.2%. If you adjust that for the number of people who just aren't looking for a job, we're closer to like 7.8% in that area. So there's still a ways to go for the job market to heal.
So is the participation rate then relative to pre-COVID? What does that look like?
Well, if we look at just the overall participation rate and where we're at right now, it's sitting around 61.7%, I think, in that general area. So,
by the way, Andy doesn't know what questions we're asking him ahead of time. It's just I'm always fascinated by that you remember some of these numbers. But
okay, so it's 61.7 now, and what do you think it was pre-COVID?
It was about 63, give or take. But if you just look at, it's just like a 20-year chart, if you will, it's been moving down. That's no secret. A lot of that is just demographics.
Will you explain could you do us a favor and explain to our listeners what participation rate means and what the difference between participation rate and unemployment rate is? And we have a tendency to see the unemployment rate in the paper, but I think actually, maybe I'm wrong, I think participation rate is probably the more relevant of the two statistics. Agreed. So explain the difference to us, please.
Well, when you think about the population of the United States. We have our total population, right? And that's, 300 million or 330, whatever it is, somewhere in that general area. But that's not everybody that's looking for a job. So then we look at the labor force, which is just the number of people looking for a job. And when we think about the participation rate in terms of the unemployment rate, that's a little bit different. So we're looking at the labor force and basically how many people are actively looking for a job as a percent of the labor force. And the labor force is just people who are eligible, if you will, for a job.
And what I think is really fascinating, if you look, the participation rate for able-bodied, I'm going to pick out a class of people, men in their 20s has declined every year, continues to decline.
And what that means is they're not even looking for a job.
I don't know if they're still living in their parents' basement playing video games or what.
Well, that is one of the reasons I actually don't have a basement.
Yeah.
Well, that's a good reason there, Pat. Now, one thing that could be a little tough to gauge when we think about the people in their 20s is also the gig economy and how that's affecting things. So there's just a lot of moving pieces out there, and everything may not be captured completely accurately. Gig economy is like your Uber drivers and things like that.
Yeah.
So and when we think about the unemployment rate, that's just a percent of people who are saying they are unemployed and looking for a job. So it doesn't account people who aren't looking for a job.
So basically, when they fill out their report that they have to do to make sure their unemployment check keeps coming, they say, "Oh yes, I'm actively looking for work." Is that right?
Yes, that's basically
yeah.
Well,
okay. Because those 15 fast food places I drove by today didn't have signs up.
It's impossible. I can't find a job anywhere.
I didn't see a single sign on my way to the office today that didn't say. Every one of them said looking for employees. Actually, I heard an ad this morning on the radio for a casino that was actually not even for promoting the casino. It was just why you should work.
Same ad.
Why you should work at the casino. So tell us.
I mean, we know how hard it is to find people too. I mean, you might mention, Pat, that it's the fast entry level jobs, but at every level, highly skilled jobs, it's just hard to get people right now.
It is hard to get.
And we have people who say, "Yeah, I want to come work for Allworth," and then they
yesterday said Amazon's not going to, or this week said they're not going to be testing for marijuana for their drivers. So they're
for their drivers.
Your Amazon package could be getting delivered by someone who might be, currently high at the time.
Well, actually, I just assumed they were.
Fair enough.
That's terrible.
I'm joking.
That's terrible.
I am joking.
That is
funny, it's too good of a joke to pass up. I apologize.
Assumed they were. All right, we got to get back to more serious matters than all this.
So inflation.
I mean, look, if when talk about inflation, worry like as leaders of an organization that works with retirees, one of my number one concerns is inflation. And if we have inflation, how do we make sure that we have our clients structured in such a manner so they have the highest probability of maintaining their current standard of living until their dying day? Right?
And if you own fixed income and that's all you own,
that's a problem.
It's an issue.
The good thing about owning some equities in the stock market is that their earnings grow with inflation. So that's why stocks are
by definition
a pretty good inflation hedge.
You're not going to have inflation without rising prices.
And you're not going to with rising
the
prices.
definition of inflation.
Yes. So talk a little bit about first of all, you had mentioned a couple things, the bills in Congress with these trillions, $3.5 trillion here, $1 trillion there. You add up, you add enough trillions, it starts adding up to real money. What are the chances?
That joke wasn't as funny as the one a minute ago, by the way.
Are those? What are the chances that those are going to pass? And if they do pass, what are the chances that we're going to see an increase in capital gains rates? And will that have a dampening effect on the economy, in your opinion?
Well, anytime you do see higher taxes, that's usually not a good thing for the overall economy, and it can be reflected in the stock price. I think, we've talked a lot about Delta variant. We talked about inflation and the Federal Reserve. I think your biggest risk might be higher taxes, and a lot of people aren't really talking about that. But if we look at what's going on with the two packages out there, the $3.5 trillion and the $1 trillion infrastructure package, the $3.5 trillion, it's hit a little bit of a roadblock right now with Joe Manchin. the West Virginia senator, saying, hey, Democrats, let's slow things down. And he is the key swing vote there for the Democrats because he's often sided with Republicans on a few things. So that could slow down this getting through. I think something still gets pushed through. It might get a little watered down from where it is now, but I think that still happens. I think the $1 trillion one will still happen. I mean, the $1 trillion one's a little misleading because it's really $550 billion of new spending and $450 billion of spending they already said they were going to do on infrastructure. So it's really not much new spending. Well, not much. $550 billion still, it's still a lot. And the question is, how will we pay for it, right? We could see higher corporate taxes, higher capital gains taxes. President Biden ran basically on the premise of raising the corporate tax rate from 22% to 28%. That's already gotten a lot of pushback from Democrats, and it seems likely that if it does get raised, it probably will. It probably goes to about 25% instead of 28%. And on the capital gains tax rate, where I think you see that impact people, it's going to be for the higher income earners. Those earning about $1 million or more, where it could essentially double and going for where you're taxed at your normal income from essentially 20 to 40%, just using some easy round numbers. Now, there's going to be loopholes to get around that. And I've been reading some articles already about some insurance products where you can shelter all of your funds in there and just never pay any capital gains tax on it. So there's loopholes.
Even illegal loopholes and yeah.
I think you do see it on the high income earners that you see the capital gains go up.
So you kind of look at things and think a greater risk for retirees, particularly those maybe in higher incomes, whatever that means. But and by the way, the average for the average 65-year-old, 65-plus-year-old, the majority of their income comes from Social Security. So if you're retired, you're going to be retiring soon, and Social Security is going to be a minority of your income, less than half of your income, you are, by definition, a high-income retiree.
The majority of our listeners, that is not the case.
Correct. That's just my whole point, is because someone might think, well, I'm not a high-income person, but relatively, you probably are. And so, just kind of going back to what you'd stated, you think a bigger risk is what the tax man could do in the next few years, more so than inflation. Is that right?
Yes, what it could do, I'll say, to the stock market, not necessarily to the average person.
Okay.
And inflation, it's a risk, no doubt. I'm not saying that. I'm just saying I think taxes could be a bigger risk, and that's not really getting as much attention as I think it needs to be.
Interesting. All right, let's move this over to the Federal Reserve. Federal Reserve, they enacted some new tools in the Great Recession, essentially started buying. They called it tapering, going out and buying bonds. They didn't call it what they're calling now is tapering, but going out and buying bonds in the overall market. And then when this pandemic hit, they lowered rates down to essentially nothing. So we're going to go out and buy all kinds of things in the open marketplace.
So essentially, before where the Federal Reserve just had control over the short end of the yield curve, they now control the whole yield curve. Is that a fair statement?
Well, to a degree, they have much less control on the longer end of the yield curve. Those are bonds that have really maturities 2 years up to 30 years. That's much tougher for them to control. Now, what they are doing by buying $120 billion worth of bonds per month, they are attempting to keep the longer term rates lower. And, you could argue they've been pretty successful on that considering where interest rates are. And
so originally they were going to say they're going to start taper off their purchases, reduce them next year. Now they're saying maybe we'll be doing the latter part of this year. What is this going to mean for the overall economy?
Well, what the Fed is doing by buying these bonds, they're making it easier for people to get loans in general, causes a lot more money to be in the economy, which is good for the economy in terms of overall economic growth. And you could argue this reducing of the purchases, keep in mind, this doesn't mean they're selling anything. They're reducing purchases. So what I call easy monetary policy or loose monetary policy, it's just going to be less loose and less easy. And that doesn't mean the world's coming to an end, but it certainly could, result in some volatility. I mean, we saw that in 2013 when the Federal Reserve did the same thing when they started to reduce the asset purchases that they were doing as a result of the great financial crisis in 2008 and 2009. So, yeah, we could see some volatility. I'll give the Fed some credit, though. They have been much more transparent in telegraphing their message out there. 2013 was just, people were just kind of blindsided by what just happened, and that's why you saw the big moves. Now, Federal Reserve Chairman Jerome Powell has done a pretty good job at that. And so really what we're going to be looking at is probably an announcement in November of tapering. It might start in November, it might start in December, but November seems the most likely time to make the formal announcement. And if I had to guess, I would say they would be done in about a year's worth as far as that, and then they would keep the balance sheet at the same rate. Now, that assumes there's not any volatility or any sort of chaos along the way, and they have to restart it because things end up not working quite as well as they want. And then the next thing we have to think about is, what does that mean for rate hikes? And that's important because the Fed has had a terrible history of hiking us right into a recession.
And so when do they actually start getting rid of all the bonds on the balance sheet?
No, they're never going to do that. I mean, they've tried to do that once before. They tried to do that, and they started to do that a little bit, but in like 2017 and 2018, they were reducing it. It started really, I think, 2018, and then COVID happened. And then they got it down to about 3.8 trillion. Keep in mind, we started at the great financial crisis, 800 billion. That was the size of the Fed's balance sheet. And they got it up to about 4.5 trillion.
And what's it today?
Around 2015 and 14. Got down to a little under 4. Now we're about 8.3 trillion right now. So the Fed, they're not going to get rid of it.
So do they just hold the bonds till to maturity? Is that what happens?
Well, they'll hold it to maturity, but in the meantime, if they want to keep their balance sheet at the same level, they're going to need to buy replacement bonds for them.
Got it.
So what they did in
maturity.
18 and 2019 was they were just letting them expire, not replacing them.
Right.
Now,
Andy?
they will replace them once they get to it.
Listen, thank you for being on the show. We're out of time.
Because this broadcast on terrestrial radio still, we have hard stops. So, as always, been great having you with us, Andy.
Thank you.
Yeah. And anyway, we're out of time. This has been Allworth's Money Matters. You can hear us every week at the same station or listen to us via podcast. We'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.